Hi, welcome to the third mini lecture for Chapter 1. We are going to stay on Learning Outcome 1-2, but we will focus on how to prepare the financial reports. Before we do so, however, I would like to go back and recap the accounting equation, which we learned in the second mini lecture. We learned that the accounting equation forms the foundation for our accounting information system and is very important. To review, assets equals liabilities plus the stockholders' equity. Assets are the economic resources owned by the company that will produce a future benefit. Focus on the word owned. On the right side of the equal sign, we have liabilities and stockholders' equity. These are the two groups that have a right to or a claim on the assets. The liabilities are the debts of the business, and so the creditors of the company, people the business owes money to, have a claim on the assets or a right to the assets because they have a right to be paid. Stockholders also have a claim on the assets because they are the owners of the company. Let's use an everyday example to discuss this. Let's say we want to purchase a home. And the house is $100,000. That's our purchase price. That would be our asset. The asset would be the house. Purchase price of $100,000. If you put $20,000 down on that house, that would be your equity, the portion of the house that you own. And then you would have to take out a mortgage for the other $80,000. That would be your debt or your liability. Assets of $100,000, that's the house. Economic resources owned by you. The debt you have, the mortgage, is for $80,000. That's how much the bank owns. And you have equity or ownership of $20,000. Right now, the bank owns a larger percent of the house than you do. We would say that the bank provided more of the financing than you did. Okay, so let's move on to page 4 of our notes. And remember, you can find these notes in the Chapter 1 folder in Blackboard. On page 4, we see the first financial statement or report that is produced at the end of an accounting period. It's called the income statement. You are already familiar with the formula, which we actually learned in the last mini lecture. The way we calculate our profit or net income or earnings, by the way, they all mean the same thing. Profit, net income, or earnings all mean the same thing. We take the revenues, amounts earned from the sale of goods or services to our customers, and then we subtract the expenses, the costs of doing business, which help us earn those revenues. Now let's look at the heading for a moment. Notice we've got the name of the company on the first line, the name of the statement on the second line, and then on the third line we have the time period covered. We can't just put the date, September 30th, 2018. We have to say for the month ended. We have to tell people the time period that's covered. Because otherwise, if we just put September 30th, people wouldn't know if we're talking about the amount of net income for the month, for the quarter, or for the year. So it's very important to the readers of our financial statements. And remember, giving them useful information is the whole purpose and goal of financial accounting. So now let's take a look at the revenues. When we look at the revenues here, these are revenues only for the month ended September 30th, 2018. Revenue for selling apps in September, revenue from providing services in September. When you see the expenses, They are for expenses incurred in September. The word incur means to receive the benefit of the cost. So the salaries and wages you see, $5,000, is just salaries and wages for work done for you during September. The rent expense of $2,500 is rent for just September. The utilities expense of $1,600 is utilities just for September, and so on. We try to match the expenses, which help create the revenue, against the revenue in the same time period, so we get a good idea of how profitable we were for this time period, the month ending September 30th, 2018. We want to keep each accounting period separate. So for September, we made a net income of $2,000 because the revenues of $12,000 were greater than the total expenses of $10,000. $12,000 minus $10,000 gives us a $2,000 net income. If the expenses had been greater, we would have had a net loss. Notice the format of the report. This is an example of a single-step income statement. We list the revenues and expenses separately. We first start by putting the word revenues, and then we list them from greatest to least and total. Then we list the expenses from greatest to least and then total. But we are going to leave income tax last, and we'll give you an example of that in a future chapter. I believe it's chapter 3 as to why we do that. Before we move on, there's one more thing. Right above the statement, we have this phrase, unit of measure assumption. The definition for this is on the Chapter 1 Accounting Essentials document that you can find in the Chapter 1 folder. But what it means is that the financial results of a company's worldwide business activities should be measured and reported using a single monetary unit. In the United States, it would be the US dollar. If we were in Japan, it would be the yen. Okay, now let's take a look at the next statement, and we're going to take that net income from the income statement, the first one, and we're going to carry it on to our next statement, which is the statement of retained earnings. We can't do this statement until we've done the income statement because we need that net income amount. This statement tells us how much in earnings or profits from other periods we began this current period with. It tells us how much we earned in net income this period and what we did with it. Did we give it away as dividends, or did we keep it and retain it in the business? And so it then shows us the retained earnings ending balance. And again, we have a similar setup in the heading. We have the name of the company first, then we've got the name of the statement on the second line, and then the time period covered on the third line. Now the first line of the report lists how much we had in profits or earnings that we kept in the company from prior periods. But Noodle Cake is a brand new company, so we weren't in existence in prior periods, so we have a beginning retained earnings balance of 0 because there was no earnings or profit until September. Then we add in the net income that we got from the income statement for this period, the month ended September 30th. And then we subtract any profit that we gave out to stockholders as dividends. So beginning retained earnings plus net income minus what we gave away and didn't retain gives us our ending retained earnings balance. Notice the date for the beginning retained earnings balance is the first day of this period, the first day of the month ended September 30th, and the retained earnings balance is the last day of that period ended September 30th. Now we're going to take this ending balance for retained earnings and use that on our last statement, which is the balance sheet. This is on page 6 of our notes. Again, we have a similar setup with the heading. We've got the name of the company on the first line, the name of the statement, balance sheet on the second, but look at the third line. In the third line, we have just a date. We don't have for the month ended or for the year ended. We have simply the date. And the reason this is that we want to know the financial position of the company at that particular date. The balances of each of these accounts change from day to day. So we want to match that date, September 30th, 2018, to the period end date of the other two statements. So this statement, which the balance sheet, which is sometimes called the statement of financial position, tells you the account balances of assets, liabilities, and stockholders' equity on that particular date. Now, if this sounds familiar, assets, liabilities, and stockholders' equity, it's because that's the accounting equation. The formula for the balance sheet is called the accounting equation. And by the way, the format you're looking at here is called the report format, where we've got the assets listed first, then liabilities and stockholders' equity listed below. When you do some of the problems in Connect and when you watch some of the problem demonstrations, we'll be using something called the account format, which shows the assets on the left and the liabilities and equity on the right. You get the same totals, it's just that they're displayed a bit differently. Okay, so let's take a look at how we've set this up. We've got the subheading assets here, and then we list the assets in order of liquidity. We're going to learn more about that in the next chapter, but essentially it means how soon each of them is used up or turned into cash. So cash is already there. We list that first. Then people who owe you money for sales on credit, called accounts receivable, when they pay you, those will be turned into cash. Now, supplies won't get turned into cash, but they will be used up, probably within the year. And equipment and software, they are going to take a while to get used up, so we list those last. And then we total the assets. Next, we list the liabilities and stockholders' equity. For the liabilities, we list them in the order they'll be paid. In accounts payable, which means purchases on credit, we usually have to pay those within a month, so we list those first. And then notes payable. These are written promises to pay. And usually we have to pay those farther into the future. So we're going to total those two liabilities. We only have two debts. And then stockholders' equity section. Now, if you remember, we've got two parts to stockholders' equity. Common stock, which represents the amount stockholders have contributed to the company in exchange for stock. This is their original investment in the company. And then retained earnings, which we get from the statement of retained earnings, that represents the accumulated profits that the company has kept in the company. And we get that amount from the previous statement that we just completed. Now, when we add the liabilities and the stockholders' equity, it equals $36,000. That matches the assets. So we've just proven that the assets equal the liabilities plus the stockholders' equity. Now, page 7 of the notes has a nice summary of the three financial statements that we're learning. Now, here's another financial statement, the statement of cash flows. We're going to be learning about that in Accounting 117, managerial accounting, because there's just not enough time in the semester to fit it into the semester. And the SUNY Learning Outcomes that they mandate for the course says that we can cover that in Accounting 117. Now, the statement of cash flows lists the activities that cause increases and decreases to cash, the day-to-day operational activities, what we invest the money in, and how we receive our financing for the use of cash. And so basically it explains the change in cash. One more thing before we go on. This page in the text is also really helpful because it shows us the relationships between the financial statements. I'm going to zoom in a little bit there. Okay, so first we do the income statement. Total revenues minus total expenses gives us our net income. That amount of net income goes on to the next statement, the statement of retained earnings. Beginning retained earnings because the net income added in from this period, less the net income that we gave away as dividends, gives us our ending retained earnings balance. Remember, your earnings are the same thing as your net income or your profit. So previous period's profits were zero because we're a brand new period. Our profits for this period are $2,000, and then we gave away some of our profits to stockholders. We call those dividends. So our ending retained balance is $1,000. We then carry that amount down onto the balance sheet, and the balance sheet proves that total assets equals the total liabilities plus the total stockholders' equity. But we need that amount from the statement of retained earnings. Oh my gosh, you weren't able to see that. I apologize. There we go. Ending retained earnings comes right down there onto the balance sheet. And then here's just a quick glimpse of the statement of cash flows, just so that you get a little preview for Accounting 117. It explains the change in cash from period to period. Now, this is a brand new company, so they started out with no cash. The beginning cash balance was zero, because when they began, they didn't have any cash. Now, where did their cash come from? Well, we had $4,000 from day-to-day operations. We used $20,000 for investing in our supplies, our equipment, our software. And I apologize, just equipment and software. And we financed the company most likely through loans. There we go. There's a notes payable, and through purchases on credit. So $4,000 minus $20,000 plus $29,000 explains our change in cash from the beginning of the period till the end of the period. Well, that ends our mini lecture. What you should do next is watch the problem demonstration of how to prepare these financial statements, and also view the problem demonstration on the relationship between them. These should be the next two videos available in the Chapter 1 folder. Thanks for your attention, and please remember to keep reviewing those flashcards daily. Have a great day.